Hello, Justine and Keith. As we're waiting for our attendees to come into the webinar, it looks like quite a bit of them have been registering so far. So we'll just wait about another minute. Looks like everyone is coming into the webinar here. We have a great number of people interested in this topic joining us today.
I mean, it is one of the most interesting topics ever, so I'm not surprised by that.
Yes.
And some great presenters.
I think it may be the most popular topic of the year, each year when we offer this. So great. We have a really solid number that are in so far. So I'll kick it off. My name is Therese Lane. I'm here in the marketing group with RiverWoods Durham. And I want to thank you all for joining us today for the financial risks and rewards of retirement communities. As we just mentioned, this is always the most popular webinar that we do provide each year. So we're so happy that the numbers are very high again today. So thank you all for taking the time to learn about financial risks and rewards. I want to introduce our presenters today. We have Keith Robertson. He's the managing director from Ziegler Capital. And Ziegler Capital is the nation's leading financial underwriter of financing for nonprofit senior living providers. And we are also joined today by Justine Vogel. She's the CEO of the RiverWoods Group. And as Justine puts it, she is a recovering accountant. And over the past 30 years, her goal has been to help bring the RiverWoods way of life to a growing number of seniors. So we always like to start out with what is a CCRC? Quite a few of you joining us today are familiar with CCRC, but we're just going to start here for those of you who may not be familiar. It stands for Continuing Care Retirement Community, and it is an insurance product. So the contracts from the communities are regulated by the state of operation. For us here in New Hampshire, that is the New Hampshire Department of Insurance. And the community's financial performance is reported to the state annually. So essentially in a CCRC, you are prepaying and insuring for your future healthcare needs, whether that is your needs may include assisted living, nursing care needs, or memory support. And a portion of your entrance fee and monthly service fee are both tax deductible. And also what is very important at a CCRC, it provides you peace of mind of knowing where your healthcare will come from should you need it in the future. So it's a smart financial decision and providing peace of mind for your future healthcare needs, but it's also a wonderful lifestyle choice. So in a CCRC, you enter while you're living independently, and it frees up your time to do the things that you enjoy. And it really eliminates home maintenance, chores, and we provide transportation from medical appointments. And we also, in a CCR community, you're going to have the opportunity to have just wonderful cultural, educational activities, whether that's on campus or off-site. So it really increases your social options. And then most importantly, you're staying in control of the most important decisions of your life. So I want to quickly just share a little bit about RiverWoods. RiverWoods was the dream of a small group of New Hampshire residents. They wanted to improve the experience of aging for others. And that dream took off. Today was almost 30 years ago. The dream took off, and RiverWoods today is now a dynamic family of 3 not-for-profit communities with the same mission to improve healthcare for experience of aging. And the RiverWoods Group is a supportive organization that provides professional fee-based services for each community. And that includes finance, information technology, human resources, marketing, and quality. And the RiverWoods Group funds the at-risk portion of projects at the communities and any new ventures. So the communities, each of the 3 RiverWoods communities are financially independent. They are separate legal entities. They don't commingle assets. And each of those communities has the annual opportunity to provide additional funding pending asset availability. The RiverWoods Group is advised by a volunteer board of directors who are focused on mission and growth. So now I would like to turn it over to, first, a quick housekeeping. As you know, you're on mute, but your questions are very important to us. So on the bottom of the screen, you will see the Q&A box. Please put your questions in there. We have allotted enough time at the end of the presentation to hear directly from you. We love they're always an important part of the program, is to be able to answer your questions directly. And we value your ideas or suggestions for future topics. So please provide those for us. Thank you. And now I'm going to turn it over to Keith.
Great. Thank you, Therese. Hi, I'm Keith Robertson, a managing director with Ziegler. As Therese mentioned, Ziegler is we're a boutique investment banking firm, and we focus on mission-driven organizations. And the division I'm a part of is the not-for-profit senior living practice. I've been with Ziegler for almost 17 years, be 17 years in about 2 months. But have been in the not-for-profit senior living industry for about 27 years, and used to work for the firm Retirement Living Services, who was the original developer on RiverWoods Exeter. So almost my entire career has been centered around RiverWoods Exeter, and Justine likes to remind me and all the other professionals that work with RiverWoods that it's all RiverWoods all the time. But it's a great cause, because RiverWoods is such a great organization. So the topics I'm going to talk about today are outlined here on this slide. But I'll tell you before we jump into the actual information that the information I'm going to provide is from Ziegler's research group. And we have a group of 4 or 5 people who do nothing all day but look at and talk to other not-for-profit senior living organizations to understand what they're doing. So we can prepare all this information that we share with folks like you. But we also do this, I would say, almost the exact same presentation to boards of directors of other retirement organizations in the Northeast, throughout the country. So they're fully aware of what's happening in the sector. So you're actually going to hear today the same information that Justine's board, the folks at the RiverWoods Group, would also hear. So they have an understanding and a perspective of what's happening in the sector, so they can plan for the future. So we always start these conversations talking about the consumer. Obviously, the demographic wave is a major driver for how we think about the future. Workforce is something that we all talk about. It's I would say maybe the most important trend that every organization in the country has to deal with. We're going to talk about how we define senior housing, talk about growth, primarily about development and mergers and acquisitions, the changing healthcare environment, especially as it relates to senior housing, other types of services that organizations can provide, and then, of course, technology. So with that, we'll talk a little bit about the elephant in the room, which it really is staffing. Staffing has been challenging for a long time, but especially during the pandemic, and now that we're coming out of the pandemic, it's acute for many organizations. They just don't have access to the folks that they need to run the programs to meet the contractual obligation to their residents. And I can tell you, this has been a problem that's been in the making for a long time. When I first started in this industry 25 plus years ago, AARP had done printed out some information, and I remember seeing that for every individual that was of care receiving age, so 75 and older, compared to anybody who was between 25 and 65, so in the care provider age group, that factor was 7-to-1. So for every one senior, there were 7 folks who were in that caregiver age. Now, today, and then looking forward into the future, that ratio is only going to be 3-to-1. So the number of people who are even just available to provide services to those who need them is greatly reduced. So as Justine and the RiverWoods group think about the future, any additional programs they want to provide, if they want to do a new development, if they want to acquire other organizations, staffing is usually the first question that is asked. Can we staff this program? It's also putting a lot of pressure, financial pressure, on organizations' income statements. It's driving the expense side of the income statement up significantly, and I think most organizations are happy to pay higher wages, but it's also really hard to find the folks, regardless of what you want to pay. All right, so then we talk about demographics. I think everybody on this presentation understands that the baby boomer generation is the largest in American history, and is shaping how we think about the future. So over the next 20 years, the number of folks who will turn 75 is going to double. So it's just it's a macro trend that is certainly going to shift the way the world looks at itself, but it's a major trend that is going to affect how folks like Justine think about the future, because there's a great opportunity, but in that opportunity there's we have to understand what that new consumer is going to want. And one thing that we'll hear from most baby boomers is what they want today is different from what prior generations wanted, which creates a bit of a dilemma for RiverWoods and other organizations, because you're not just, even though you're preparing to serve the baby boomers and still serving some right now, we're still currently serving prior generations that had a different perspective. So it's really understanding what the current residents want and need, but also planning for what future generations want. And there's a bit of a dilemma there, but we have to keep thinking about the future. All right, so I'm going to talk a little bit about the health of the industry. And so the next 2 slides are talking about occupancy. Occupancy generally is improving as we come out of the pandemic. We've got this information from NIC, the National Investment Centers of Seniors Housing, and you can see that occupancy is improving on the independent living side of CCRCs. We're right around 90%, and this time about a year ago, we were about a percentage point below that. And we're seeing increases in really all levels of care: assisted living, memory care, and skilled nursing. The unique thing about the skilled nursing piece, and we'll talk about skilled nursing in a couple more slides, but the actual numbers, even though occupancy is improved, and I would say fairly significantly improved over the course of a year, the number of skilled nursing beds has actually gone down. So it's not necessarily because there's more folks in skilled nursing, it's just because the denominator has reduced. Looking at the next slide, you can see that occupancy took a major fall during the pandemic for both the not-for-profit senior living industry as well as the for-profit sector. But we started off right around, I would say, 92 to 93% on the not-for-profit side, and about 88% on the for-profit side. Going back to the pre-crisis years, we were pretty average, right around 94 or 95%. In the Northeast, we were actually higher than that. This is a national statistic, but then in the financial crisis years, occupancy dropped fairly slowly, but it leveled out right around 90%. And we stayed right around 90 to 91%, for the remainder of the 2020s, never really getting back up to where we were pre-crisis. And now we've had this significant fall during the pandemic, and occupancy is creeping back up, but it feels as though it's leveling out right around 90%, 89 or 90%. So not getting back up to the same levels that we were prior to each one of the major challenges that we've had in the economy. Looking at the for-profit line, going back one slide, the So the for-profit CCRCs have seen greater improvement in occupancy, but that's generally because they don't offer an entrance fee product. They generally offer rental, and rental tends to be a bit more fluid than the entrance fee product that's offered by the not-for-profit sector. So Ziegler, we do a lot of research, and one of the things that we do is a CFO hotline. So Kevin Goyette, the CFO of RiverWoods, every quarter gets a survey from Ziegler. And the most recent survey was asking organizations like RiverWoods, how do they plan to grow? So we were actually really excited to see that over half of the organizations that responded to this survey are planning on growing, but by doing some kind of unit expansion. So unit expansions, anywhere from 20 to 50 new units, is generally what most communities across the country are doing, but also here in the Northeast. And so that's the primary way organizations are growing. There is a macro trend towards mergers and acquisition type of opportunities. On the not-for-profit side, we like to use the phrase sponsorship transition because it's not necessarily a sale or an acquisition. Usually it's a member replacement of some sort. So about a third of the organizations that responded to the survey are looking to grow through some sort of sponsorship transition. And then in terms of new campuses, we see about 20% of the organizations are looking to grow through new campus development. I was actually pretty shocked when I saw this statistic because we're actually not seeing a lot of new campus growth in the sector. I would say really since the crisis years back in 2008 and 9, we used to average in terms of new campuses per year, about 10 to 12 new campuses opening up every year. And since to 2010, we've only averaged around 2 or 3. So it's nice to see that organizations are thinking about building new communities, but what they're looking at building now is different from what they used to build 15, 20 years ago. And we'll talk about that in just a minute. So we do talk a lot on the not-for-profit side about the difference between the not-for-profit sector and the for-profit sector. Both provide nice homes, generally quality homes, but the for-profit sector, like they're there for profit. It's really in the name. And on the not-for-profit side, we like to say that they're there for people. But the blue line down below, or the blue section down below compared to the green section up top, the blue is the not-for-profit sector growth, number of communities going back to 1980. And you can see the growth is fairly stagnant on the not-for-profit side. However, on the for-profit side, going back to really right around 2010, 11, or 12, there's a real uptick in the amount of growth that the for-profit organizations were embarking upon. So they created this major shift away from the not-for-profit sector. So not-for-profits really haven't kept up, even though the not-for-profit organizations still see the same opportunity in terms of the demographic information that the for-profits see. The for-profit organizations have just been more aggressive in pursuing that opportunity. It changes the landscape for a lot of not-for-profit organizations because not-for-profits, they might be the leader in their market, but with enough for-profit growth, they become almost secondary in many markets, not necessarily in New Hampshire. So here's just another slide showing the growth of the for-profit sector compared to the not-for-profit sector. So this is the number of properties that are under construction as of last quarter. And on the not-for-profit side, very small numbers, less than 50. But then you look at the for-profit sector, and it's almost 300 new properties across the country. So just additional information showing how great the difference is between the growth strategy of the for-profit sector compared to the not-for-profit sector. Shifting our attention for a minute to that sponsorship transition approach that many organizations have utilized to grow. So this is a slide showing the number of not-for-profit communities that have changed hands since 2015. And that's the orange line up top. And then you look at the number, or the purple line, which is the number of transactions. So many of the transactions are for multi-site organizations. But so there's been a lot of activity on the not-for-profit side of the industry for the better part of a decade. If we were to go back to before 2010, the number of communities is over 1,000 communities. Since 2015, roughly half, about 46% of all those not-for-profit communities that have changed hands have ended up in the hands of the for-profit sector, which is very disappointing. So even at the same time, we're not building new buildings and we're not necessarily growing at the same pace. They're actually taking not-for-profit communities and putting them under the for-profit umbrella. A lot of reasons for that. A lot of them are distressed situations where not-for-profits just can't step in effectively. And the for-profit sector, they have different access to capital, generally faster access to capital. They have an ability to make decisions a little bit quicker than the not-for-profit sector. But it's really all these past couple slides talking about the for-profit versus the not-for-profit sector. The for-profit sector is growing substantially. In some years, going back to about 2011 or 12, it's been about a 20 times factor in growth over the not-for-profit sector nationwide. Very, very, very significant. So as organizations have been going through sponsorship transitions, moving away from the not-for-profit sector, there's been a very significant move within the not-for-profit CCRC sector away from single sites. So RiverWoods Exeter started off as one campus, built the Ridge and the Boulders campus a couple of years later, but I think was still considered a single site. That's how I would say the Northeast primarily was, and maybe generally still is. But across the country, single sites are really becoming very scarce because they generally merge into much larger systems. Most of the growth that we're seeing in the sector right now is coming from those multi-site organizations. We on the development side, we say it's the hardest thing for any organization to do is to go from 1 to 2. Once you've done it once, if you've gone through the thought process on how to grow to a multi-site, usually the campus number 3, campus number 4, acquisition number 1, acquisition number 2, it's easier because you've already done it. You've seen that you can be successful. You know where you need to really focus. You can improve upon the weaknesses in your organization, and you really know what you're looking for. But we see that 28% of all the CCRCs being single site, we see that number dropping to probably less than 20% over the next couple of years. So that trend of moving away from single sites is accelerating. Next slide. So talking a bit about new locations, we are expected to see about 40 new openings in the next 5 years. So it's on average about 8 per year. So we're starting to see some activity. A lot of the campuses that we're seeing opening up now are not your typical CCRC. They generally don't include skilled nursing. So for a long time, the definition of a continuing care retirement community was you had independent living and then a continuum up through skilled nursing. Most of the communities that are now being built are either just independent living or independent living with some kind of assisted living, whether it's straight AL or memory care. So that's a major shift. And we won't spend too much time talking about the skilled nursing sector, but there's major changes and on the skilled nursing side of the business. Next slide. So another macro trend that all of us in the industry are so focused on is technology. As we're dealing with staffing issues, a lot of the technology solutions help manage some of the challenges created by the lower staffing levels, create efficiencies, but we're also seeing a much bigger acceptance of technology by our consumer, by the residents. I think during the pandemic, we were forced all of us were forced to truly embrace technology. Telehealth is a huge one. I think before the pandemic, very few of us ever had a telehealth appointment with our doctors, and now it's commonplace. So there's just a lot of opportunities. So it's this topic right here that we see the real differentiation between the single sites and the larger systems. A small single site doesn't have the capacity, whether it's personnel or financial, to really dig into the technology opportunities that are out there, let alone implement it, keep up with it, and make changes as changes are necessary. The larger systems, the larger organizations like RiverWoods, They have teams, and they have the ability, because they have significant scale, to truly invest in technology and understand it and find ways to improve not just their business, but also the lives of their residents. So that's one of the lines that we keep seeing between the single sites and the systems. The systems are so much better with technology. So as you're thinking about something in the future, if you really embrace technology, systems are really where that opportunity lies. Next slide. So we're not going to get too deep into the capital markets. I think it's way too depressing, especially for people like me, whose income is based upon getting deals done. But it's been a very, very challenging time. And so this graph here shows the number of rating upgrades compared to the number of rating downgrades within the not-for-profit senior living industry. There's about 160 rated organizations. RiverWoods is rated A- by Fitch, so one of the strongest rated organizations in the country. But we're seeing a lot of organizations, especially during the pandemic and now coming out of the pandemic, experiencing downgrades, which is a sign of poorer financial performance, potentially having lost a lot of money from in their portfolios because of the stock market shifts. So on all fronts related to financial performance, we're seeing challenges really across the sector. But again, the larger systems have historically done a lot better in terms of maintaining financial strength, even during hard times, than the smaller single sites. So as I sit around and I think about how to compare a RiverWoods to really any other organization, we try to find resources that really track industry performance. And I can tell you there aren't a lot of great resources out there. It's sort of a mishmash of resources. Rating agencies are a great way to sort of see, who are the strongest. So there's 1,911 CCRCs in the country. About 75% of those are not-for-profits. So maybe 1,500 not-for-profit CCRCs, and there's only 160 ratings. So many of the organizations are not rated at all. So we see being able to get, especially an investment grade credit rating, but also in the A category, as one of the greatest signs of financial strength. And RiverWoods, as I mentioned, is A- rated. There's an accrediting association called CARF. CARF, the number of organizations that they accredit has declined significantly over the years, and they see that declining even further. But it certainly is a great source of information about at least those organizations that are accredited. There are some industry publications, but the place that I go to most often to understand how organizations are doing is I look at their covenant compliance, and there's a great website. It's called emma.msrb.org, and you just Google, or you just put in the search bar the name of the community, and generally all their public disclosure comes up if they have outstanding public debt. RiverWoods does not. All your debt is private debt, but that's a great resource as well. And we are working hard with all organizations to improve the consistency of their disclosure, so we can really compare apples to apples. Right now, that's very, very hard if you're looking at community financial performance. So with that, I'm going to turn it over to Justine, and look forward to questions later on.
All right. Well, welcome everybody. And as we said in the intro, I have been at RiverWoods since 1994. I started as the director of accounting about 2.5 months before we opened our doors on our original campus. So I say that for a little bit of history and a little bit of just a warning. The reason I put a recovering accountant down here is I'm not nearly as interesting as Keith, but I'll do my best. When we think about, Keith talked about the industry, our sector, what's happening nationwide, and I'm going to talk a little bit about how this impacts you. So when we think about what is your regular 75-year-old to do, right? What options are available to you? We think about them in 5 categories. There is, you can stay home and say, I'm happy here. I'm never going to need any services. That's a very optimistic viewpoint. It may be a little bit of denial. And that's linked to the next one down, which says, you know, I'm going to stay home and I will bring services in if I ever need them. And that's pretty hard to do. It's also optimistic, a little bit of denial. It's harder to do today. If you hearken back to Keith's statistic that 20 years ago, there were 7 people in the workforce for every older adult. Today, that's 4, and it's going down to 3. It's just very hard to be able to coordinate and afford all of those services on an ad hoc individual basis. The next option is cohabitate, which not nearly as fun as my 26-year-old daughter is living with her boyfriend. It's by this we mean, you know, the concept is, or my plan is, I'll move in with my kids, which is a totally fine plan. You raise them, you know, they owe you. But what we say to people is, if that is your plan, you should tell your kids. You should, in fact, warn them that that's your plan, because there's a lot of change that happens when you have multi-generational living. The next option is someone will say, well, I'll make a change when I need to, and I'll move into assisted living or nursing home. And that's an emergency-based decision, and that's fine too. But understand that that would not be a decision you're making. Someone is making that decision for you. And so if that's your plan, what we would suggest is get to know the organizations around you and where you might want to receive care, and share that with your family or your loved ones who may be the decision makers for you in an emergency. And of course, the last decision is what we think of as the most intelligent and involved decision. And that's, you know, I'm going to make my change now when I'm planning for my future, and that's choosing a CCRC or a life plan community. There are multiple contract types. So one CCRC is not the same as the other. There are a variety of contract types. Primarily the difference between them, type A, B, and C, is the amount of insurance that they provide. In a type A community, that's unlimited. In a type B community, it's a defined amount of insurance. And in a type C community, it's all fee for service. Now, there's not one is not necessarily better than the other. You know, folks might choose a type A community because they're the type of person that wants to have the most insurance and have known costs for their future healthcare expenditures. So that's what's important to them, that they've got that covered. They might choose a type B community if they have long-term care insurance, or if they are willing to accept some of that risk themselves. So when you move into a type B community, you're going to have a defined insurance on your long-term care expenditures and a defined discount, but at some point that's going to go to a market rate. And people may be willing to accept that risk, and they may have long-term care insurance to cover that. And folks who choose a type C, again, they may be folks who are decided that they do not want to buy the insurance. They don't want to pay for anything that they may not ever need. And so they're taking that risk themselves, but they're choosing the community option. Some folks say to us, well, it doesn't Medicare or government programs pay for my long-term care needs. And the simple answer to that is almost always no. The Medicare requirements are quite strict and getting stricter. There's nothing in government programs that are becoming more simple or more rich for older adults. So they are based on acute needs. So if you have, you have long-term needs based on physical or cognitive challenges over the course of time, or based on your maybe a disease process, Medicare is not going to be the answer for you. Now, long-term care insurance, we do think that is an important bridge to the future for folks who are living on Main Street, because it does provide fixed financial coverage for a fixed period of time, but it doesn't answer the questions that a CCRC does, which are cost and quality and availability and location. There's only one option that provides that, and that's a CCRC. So when you choose to move to a CCRC, you're committing to that CCRC for life. In fact, the contract is called the life care contract. So you need, as a consumer, you need assurance that that CCRC will be there for your lifetime. And what we think about are, and just, we'll run through here some basics. How do you ensure that you're comfortable that your provider, your CCRC, your community will be there for your lifetime and beyond? Some very basic things, audited financial statements and the availability to look at those. Understanding how often the community engages an actuary to do a comprehensive study. But we, as communities, we're making very long-term decisions based on your lifetime, but interest rates and the anticipated costs of services, and that impacts pricing. And while a lot of that is accounting based, also a lot of it is actuarial based. So many states, our state included, require an actuarial study every 3 to 5 years to just check the community and ensure that you can still keep your commitments. And then one that isn't necessarily, doesn't necessarily sound financial, but, obviously you're going to go take a look at the community, take a look at the buildings and grounds. And we have, at RiverWoods, we have 1,100 plus or minus residents. And I can assure you that there are not 1,100 people who agree that we invest the right amount of money and the right amount of in our physical plant at any point in time. Some people would like more in our landscaping or new carpeting or shingles or siding or paint or, more comfortable furniture. The idea is take a look around and ensure that the community is continuing to reinvest in its physical plant. On the governance side, there are some basic questions to ask too. Number one, is there a resident council or resident finance committee? Is the resident voice heard? That doesn't necessarily mean that the resident organization is driving the decisions, because again, we're an insurance product. So there are many decisions that are business-based that may not be popular, but you want to ensure that every decision the community makes has that resident voice in it, that it's been heard. As Keith said, the difference between for-profit and not-for-profit is for-profit or for people. The way we talk about it is that there's a person at the end of every decision we make. And so you want to make sure that that input is included in the decision-making process. Does the community have a benevolence clause? That's an important thing for charitable not-for-profits. With any organization that is a charitable not-for-profit, a resident who outlives their assets through no fault of their own is handled by the community, is covered by the community through benevolence. And so that's a commitment that the community makes to every individual, that they will be available for them for their lifetime if they were to outlive their assets. And then perhaps the most important one is, does the board have ample expertise? So nonprofit communities are governed by volunteer board of trustees. And you want to take a look at those folks. You want to make sure that these are people who have breadth of experience, that they can guide the organization. They don't manage the operations. They have a professional management team for that, but that they can govern the decisions, and that they are always looking out 5 years, 10 years, 15 years. What are the trends, and how does that impact how we deliver services today? One of the things we think about, and just, some pretty basic things here, but what causes issues in our industry? And Keith talked about, it is getting harder. In the course of my 29 years in the industry, there have been easier years and harder years. And I'd say we're in a trend where things are a little harder. And much like, we talk about democracy as the absolute worst form of government, except for all others, I would say CCRC's, kind of the worst way to run a business, except for all others, because we're taking all of the factors that you would have to deal with as an individual and homogenizing them, bringing them together in community and working on them together. Now, not all communities are doing well. And so what happens, what causes problems in mature communities. It's generally about occupancy. Keith talked about a drop in the financial crisis in 2008, and then with the pandemic into the mid 80s, high 80s, and then somewhere around 90% now. If that doesn't continue to get better for an organization, that's a challenge. Some organizations end up with too much debt if they don't work with someone as sophisticated and intelligent as Keith Robertson. But you can end up with too much debt if you have an expansion that doesn't go well, if it doesn't fill up quickly, if you have to borrow at unfortunate interest rates. Aging physical plan, we've seen that with some of our friends in the industry where cash is a little tight, they're not reinvesting, and then all of a sudden you have a bigger problem to deal with than you had anticipated. But I would say the biggest thing that causes issues for us, for our industry, is an inability to change. In the nonprofit world, in the charitable nonprofit world, in the charitable nonprofit CCRC world, our customer, you, live where we work. And the best decisions for the future are not always popular decisions. And we, nonprofits in general, I hate to generalize, but nonprofits in general do not operate at a rapid pace. And we tend to hate change. And so the inability to change for most organizations, that's what causes problems. The inability to take some risk or deal with what may be unpopular today, but is important for the future. When we think about new communities, for years and years and years, the biggest cause of issues would be a slow fill up, because the biggest risks are filling up quickly and the debt burden. So when you borrow $100 million to build a building, even a 1% change in interest rates is $1 million in expense per year. And, that starts to add up after a while. So forever, quick fill up and the debt burden were the biggest issues. And as Keith said with his elephant slide, the new wrinkle is startup staffing, right? Can you fill all of those positions to be able to provide the services that you promised? So those are just that's just an overview. We've created this workbook, the Insider's Guide. It's on our website. Feel free to download it. Has all of these questions and more. It's just a way of looking at communities and for yourself, right? And there is no one right answer. I tend to think that there are, particularly in New Hampshire, many good options, most of them just slightly less good than us. But as CCRCs in New Hampshire, we're all generally quite strong. And you want to take a look at all of these questions and understand what's important to you and how do you evaluate this for what's your preference, what's important to you, whether that's size of apartment or the people you live around or the financial strength of the organization. Everybody has a slightly different, guide there. So how do you focus these things? Financial ratios are important. As Keith said, it's hard to compare one community to the other simply because most of our services around the industry, it's 1,900 CCRCs, the packages of services are slightly different from community A to community B to community C. But there is analysis that's done every year that is a joint project of Ziegler, Keith's organization, CARF, the accrediting organization, and Baker Tilly, which is a large accounting firm that serves in our industry. And they put together comparative ratios for a variety of financial ratios. So there are benchmarks that we look at as we go through this. And I will talk about those benchmarks in a bit, but the financial benchmarks are not the only, they are backward looking. right? That's how did a community perform? Occupancy is going to tell the story. It's the lifeblood of a CCRC. So a fully occupied community is going to do better, all things being equal, than an 85% occupied community. So occupancy is super important, and how long it takes to fill up and how long a community has stayed full, super important. Key financial ratios in a variety of areas. How is a community doing in terms of margin? Meaning, are they charging residents enough money to pay their operating expenses? How's the community doing in terms of capital structure? Meaning, is their financing appropriate for their community as they're performing? And then in terms of liquidity, do they have enough cash as compared to their debt, as compared to the need for capital reinvestment? As Keith said, it's really hard to find exact benchmarks, right? And say everybody handles everything the exact same way. Accreditation is one way. Our RiverWoods Exeter community is accredited. Our RiverWoods Exeter community is rated. But another way to look at benchmarks is to look at historical data for the community. That'll give you a sense of trends, and a comparison to budget or goals will give you a sense of where's the community heading as compared to their strategic direction. So I hope what you're finding is this presentation is not it's not a commercial for RiverWoods. It is a commercial for the concept of CCRCs, but I am going to talk a little bit about our ratios, so a tiny little bit of RiverWoods commercial. Before I get to that, though, occupancy is super important. 95% is what we consider full capacity, and the trends of a community are almost as important as where they are in terms of numbers. So if a community has been on an upward trend or it's been steady in terms of occupancy, it gives you a sense of stability. If there's a sizable wait list, that gives you a sense of stability. In healthcare units, that's a harder thing to control because healthcare is a need-based thing. But what you want to know is how is the community managing census and staffing, right? Do they have the ability to look through these things and see the future, or at least see good paths forward? I do want to talk for a minute just about the benefits of being a charitable not-for-profit as compared to the responsibilities. So Keith talked about not-for-profits as compared to for-profits. We are a charitable not-for-profit. The CCRCs in New Hampshire are charitable not-for-profits. That comes with a variety of benefits. So exempt from income taxes and generally partially exempt from property taxes here in New Hampshire. Being as we don't have other taxes, nobody lets us fully off the hook. But you also have the ability to borrow at tax-exempt rates, which are 65 to 75% of for-profit or regular borrowing rates. But that comes with responsibilities, and that is serving the greater good. So for us, that's not everybody, but it is special for older adults. And the reality that we need to be here forever. So for-profits, as Keith talked about, that growth structure, there is much more activity in M&A in the for-profit world, because if something isn't working in the for-profit world, a for-profit will, cut and run. And as one of our board members says, for-profits cut and run and not-for-profits stick and stay. So we're in this for perpetuity. And I think that's a big differentiator in the nonprofit world. The other thing I want to talk about just before getting into just quickly in our ratios is that CCRCs are a complex business. We are your home. We are a place where you have fun and exercise and social interaction and nutrition. And we're also an insurance product, and we're also a healthcare provider. And our goal is to simplify it for you as an individual. And that's not just RiverWoods, that's all of our friends around the country too. But there's a lot going on under the water as we simplify it for our residents. So sometimes folks will confuse the resident voice with a need for more say in terms of running the business. And all I can say is when you think about all of the many levels of complexity that come along with running this organization, our lenders and our boards require a professional management team to make that happen. So I'm going to talk for just a few minutes about the RiverWoods difference, what we think of as what has made things successful over the years. I think we have always been independent and forward-looking. So as an organization, over the course of 30 years, we've grown from a single campus to 3 campuses in Exeter to 3 communities across the southern New Hampshire. And I think that's been a product of these 3 mantras: protect the core, maximize our resources, and plan for the future. Never one more than the other. And as I said, one of the things that gets mature communities in trouble probably isn't protect the core, and it probably isn't maximize the resources. It's a lack of plan for the future. Important, quality and tenure of our management team and our board. They're just a fantastic group of people with a breadth of experience. And as Keith has noted, our Exeter community is A- rated. I think the biggest difference, though, is that we have formed a family of communities. So as you see on the screen, as a part of our system or a family of communities, we have our Exeter community, which has 3 campuses, Manchester, which joined us in 2016, and Durham, which we built and opened in 2019, right before the start of a global pandemic. So that was interesting, but again, speaks to the importance of a really fast fill. The bucket to the far right is what we call SPE or STE, which stands for someplace else or something else. And while we don't have, always have exactly what that might be in mind, it's just sort of a reminder to ourselves, to our residents, and to anyone who's interested in us that there's more to come. There is more to do when we're always thinking about the future. So I'm going to end with just 3 quick slides on our ratios before we open it up to questions. But just to give you a sense of the 3 categories that we look in. One is margin, and this represents RiverWoods Durham. And what you can see here is the community opened in what was fiscal year 2020, which was a year that I think all of us would like to forget, except for the fact that we opened a beautiful campus. And what you see is new communities lose money in the beginning. There's fill up, there's startup expenses. CCRCs have a lot of fixed costs. So until you get to stable occupancy, you lose money. But by fiscal year 23, so in the course of just 3 years or 4 years, and 3 of them being during a global pandemic, RiverWoods Durham came to be a positive margin. So we're very proud of that. On the liquidity side, just as an example here, is RiverWoods Exeter. And what we note here is days cash on hand. Days cash on hand gives you a sense of, could you pay your bills if you never made another dollar? So it's not a very practical ratio, because hopefully you're never going to never make another dollar, but it gives you a sense of how much security you have in hand. And RiverWoods Exeter, a very high standard. I think the industry triple B plus rating is about 350 days. Is that right, Kate?
That's correct.
Yeah. And so, RiverWoods Exeter runs in the $500, $600, $700 days cash on hand. And then for RiverWoods Manchester, the other thing we measure is capital structure. And capital structure gives you a sense of how is your cash as related to your borrowings. RiverWoods Manchester is over 100% in terms of cash to debt. What that means is we could take our cash and pay off all our debt at any point in time, and do better. Now, because we borrow at not-for-profit rates, that's generally, and we can invest in the regular markets, it's generally not a good idea to pay off your debt all at once, but it is a lot of comfort to have that in hand. Last thing we'll note before turning it over to Q&A is the other practices that we think about, and an important one is having a written financial philosophy. So monthly financial reporting, quarterly reporting, all resident meetings, all residents on our board of trustees, all important. But one of the things that we're most proud of is having a written financial philosophy. We've made a plan for how we're going to operate financially. It doesn't mean that we hit it every year. The pandemic definitely changed things for us for a short period of time. But it's important. You never know if you are going to the right place if you haven't planned out where you're heading. So for us, that's about how are we looking at our expenses? How are we looking at our revenue? How are we looking at our capital reinvestment? How are we looking at our investment performance, all together in a way that gives us the most comfort that what we'll be able to do is keep our commitments to our residents for their lifetime and beyond. So with that, I will turn it back to you, Therese.
Great, thank you, Keith and Justine. That was terrific. Along with a lot of questions we've received some comments that they really appreciate, both of you, the presentations that you provided. So let me dive into the questions. Jan is wondering what percentage of one's entrance fee and monthly fees are tax deductible?
That is a question that is answered every year. We have an outside accounting firm, prepare that for us every year, and it changes a small bit every year. I don't know that off the top of my head, but my guess is that our marketing team has access to the most recent letter that they can share with you. I will say that the non-refundable portion of your entrance fee for years and years, that is generally 100% tax deductible. And then a portion of your monthly service fees.
Yeah, and Justine, we go by 25 to 35% in between that range of your monthly service fee. The last year, most of the community was around 34%.
And the reason that changes every year is the way it's calculated by the outside firm is it's a portion of our expenses related to independent living versus our expenses related to healthcare. So every year that changes a little bit. And so every year the percentage changes a little bit.
Okay. And our the finance team does provide a detailed letter each January for residents to share with their accountants regarding the tax deduction. And then Ruth also has the deductible portion of the entrance fee month is based on what number? I think we just covered that. All right. And then what kind of growth or expansion is RiverWoods planning overall for your 3 locations?
Right now, what we're in the midst of is within our RiverWoods Exeter community, our plan is to centralize how we provide healthcare. So right now, each campus, the Woods, the Ridge, and the Boulders, has a distinct healthcare center, which we have determined is just not the way of the future, as Keith talked about the staffing challenges, and there are a variety of other reasons. So for Exeter, the expectation is we will centralize healthcare, and the existing healthcare units will become independent living units. That's likely in the 5-year timeframe. In RiverWoods Durham, we own some land across the street from our existing community, and we're just starting to evaluate what we might be able to do there. And in RiverWoods Manchester, I'm sure many of you know, we engaged in a cottage project. Sorry to say, I believe they're all sold out. So, but get on the wait list. But those cottages start opening in January, and the last of them open in April of 2024.
All right, Keith, this is for you. If you just wanted to review, why is there such a growth disparity between not-for-profit and for-profit?
It's a good question, and I think it's multifaceted. Their access to capital, they have access to equity, to private equity, and that money is very abundant right now. So they have plenty of access to capital. The not-for-profits need to go through a whole financing process as opposed to just being able to write a check. So I think the capital access is one of the major drivers, but it's also an approach to doing business. So most for-profits view growth as an opportunity to make additional profit. So they generally grow quite aggressively. Many of the for-profit organizations, at least the larger ones, they'll do 2, 3, 4, 5 new buildings every year. But they also have an approach where they don't necessarily care if all those buildings are successful. So it's a much more aggressive approach. If 2 or 3 of those buildings don't work, then they sell them, and they might lose some money, but as long as they're making their profit on the other buildings, they're okay. On the not-for-profit side of the world, if RiverWoods were to do any growth initiative, they have to be successful with it. They don't have the ability to not be successful, so you have to execute flawlessly on whatever those growth plans are. So generally, it's just that it's that risk tolerance, but the need to be successful is generally why not-for-profits don't grow as fast. They never really did grow as fast, but over the past 10 years, the for-profits have really amped up the growth, primarily because they have access to capital and they see the demographic opportunities in front of them.
Great, thank you. And Janet's asking the acronym LPC, that is Life Plan Community. And Keith, where can they get the new Ziegler report?
So I'm not sure what the actual question is. We have a lot of information that we provide. We do have so on our website there are all of our we have a weekly what we call Z News. It's our weekly newsletter. So most of the information that we do collect and provide is usually in our newsletters. So those are on our website, and which is www.ziegler, which is ZIEGLER.com.
Okay, great. The next question, how many CCRCs are in the country? That was 1,911?
Yep.
And the percentage that are not for profit?
It's 75, so there's 1,430.
Approximately.
Okay, great.
Calculator.
What are the pros and cons of private versus public debt?
That's a great question. And I've been having this conversation with Justine and Kevin Goyette for, I would say, well over a decade at this point. Generally, public debt is fixed rate bonds. So that the interest rate is set at pricing of the bonds, and it's for the full maturity of the loan, which is generally 30 to 35 years. Private debt is generally, it's a private placement with a commercial bank. It can still be a 30 to 35 year financing, but the bank is only going to commit for a period of time. Generally, what we've been able to do with RiverWoods is anywhere from 10 to 15 years. So there's a refinancing event at some point in time in the future, which does generally increase the risk of that plan of finance. But those rates are generally lower than the fixed rate. So it's really a risk and reward concept. So fixed rate debt, it's issued, the interest rate never changes, and your investors are locked in for the life of the loan. Bank debt, generally a lower cost of capital, but you do have some risk, some interest rate risk and bank renewal risk.
And at least historically, that bank debt, it's significantly lower cost of capital. So again, when you borrow $100 million, it adds up quick.
On average, about 200 basis points. It's less right now because the bank market itself is so challenged.
Okay. Where can we find ratings of other CCRCs?
That's a great question. The Fitch data is generally reserved for those who have paid for the service. But on that EMA website, so the msrb.emma.com, all the public ratings are listed on those organizations' EMA page.
Right. And Justine, this is for you. I have long-term care policy. How would that work at RiverWoods? Is there assistance in completing the paperwork? do you offer an entrance discount for holders of long-term care insurance?
We do not offer an entrance discount for holders of long-term care insurance, and long-term care insurance will pay you back. So some folks, generally folks who move into our type A communities, have a big decision as to whether to keep that or not, because you're already insuring with a type A community. Folks who move into our type B community, they, or actually anyone, if you receive healthcare, so if you're in our assisted living or in a nursing home level of care, your long-term care insurance policy may pay you back. Our finance team will help you figure out whether or not it will qualify, but the payment and submission is an individual's responsibility. So basically, you pay us, you take your bill and submit it to your insurer, they'd pay you back. But that it does not, you have to be receiving a certain amount of assistance in daily living, and every long-term care insurance policy is a little bit different. So you have to look at that and understand, will that pay for assisted living or only nursing home care? What are the qualifying factors? But we can help you, our finance team can help you understand, and we help our residents understand whether or not that is something that is available to them.
Great, thank you. Yeah, a lot of people were interested in long-term care insurance. Are residents of the communities volunteers on the board, and what would it take for RiverWoods to improve its risk rating? Why no public debt?
So we have on our CCRC board, we have 5 residents on our board, and on our system board, we have 1 person who happens to be a resident. It's he's not on the board because he's a resident, but he's on the board because he is who he is, and he happens to live here. But so I would just like to clear up, and I'm sure Keith can speak to this. We haven't avoided public debt because of our risk rating. In fact, because we're such a good financial performer, private debt is an option for us. So many organizations don't have that option. So private debt or the bank market, less expensive. It's been a significant saver for us over the years.
Yeah, it to the tune of probably tens of millions of dollars over the course of time. I think the one differentiator between public debt and private debt as it relates to RiverWoods is sophistication. A lot of organizations go the public debt route because they don't want to have to worry about it or think about it in the future. RiverWoods, with Kevin Goyette as CFO, it's more of an actively managed debt portfolio, and he's always in front of the banks. And if it's a 10-year transaction, usually at year 3 into that 10-year deal, is looking for an extension. So it's a sophistication level that Kevin and RiverWoods in general is not afraid of having that higher risk type of debt. But they also have sufficient cash reserves. So the more cash you have, the less risky that bank debt is. Because if worst case scenario were to happen, there is cash there to help offset that refinancing risk in the future.
Right. And Keith, this is for you. Are single site CCRCs, which are under management of a larger senior living management organization, an example, Life Care Services Corporation, are they at greater or lesser financial risk?
That's a great question. It's funny. I was actually having a conversation with a client board chair just yesterday about this topic, and it's sort of it's a dual-edged sword. So on one side, they get the benefits of that scale, the sophistication of being with a larger third-party manager. Because they have access to technology, they have systems in place that a standalone single site that's operating on its own wouldn't have access to. However, the management fees that single site pays to a third party manager are usually very, very significant. So even though you're getting some of the sophistication or the benefits of scale from that third party manager, you're also paying a very large fee for it. So it's somewhat offsetting. I know a lot of organizations that have started out with third-party managers have tried to move towards being self-managed. So that's generally been the trend, because it just costs a lot less.
Okay. How can you obtain the various parts of the financial ratio analysis? For example, occupancy.
I'm not sure that industry publication is available to everybody. Is it, Keith? I'm not.
I don't think it's not a public document. It's you can buy it. I think it's a couple $100s to buy it.
What happens if financial stability and benchmarks look great today when applying and joining the wait list, but deteriorate in the future once living in a community?
I'll start on that one, Justine. You might want to add.
Mhm.
That's a good question. And generally, if an organization is strong, and then doing all the things that Justine said that organizations like RiverWoods do, generally that financial strength doesn't deteriorate, if at all. Usually they get stronger, but at least it's managed, and it's usually a slower burn. But as you're watching, if you do move into a community and occupancy is strong, all the numbers look good. The one thing that I tend to focus on is how much are they reinvesting back into their campus. Because the numbers can look great today, but if you're not reinvesting back into the campus, at some point in time, folks aren't going to want to move in. Because it becomes older and tired and dated, and occupancy is the fuel that drives this engine. And ultimately, if they're not reinvesting back into the campus, even though the ratios may look good, it's that lack of reinvestment that will hurt them in the future. So if you're at a different community and you're seeing that the ratios look good, but they're not reinvesting, you need to encourage them to reinvest so folks will want to move in the future.
Thank you. What is the plan for securing accreditation for Manchester?
We're starting to think about that. Exeter is going through its reaccreditation process now. As Keith said, fewer communities are going through that process. We're evaluating two things for Manchester and Durham. They are not accredited. Exeter is. So we can do one of two things. We can go through the whole process, pay the fee, go through every step of that, or we can learn what we're learning through that accreditation process and bring those learnings to Manchester and Durham to ensure that we're doing all the important things that align with the way we do business. So we're not quite sure yet.
Okay.
I will say this: accreditation or not doesn't mean good community or not. It means the community is making a choice. I fully believe that if we went through the process, both Manchester and Durham would be accredited. That's not the challenge.
Right. I think in your type A contract, you refund 90% of the entrance fee if a resident pass away.
Right.
Another CCRC we are looking at does not refund any amount. How are you able to maintain this refund rate?
Well, I might ask them why they aren't refunding 90% of your entrance fee. There's a variety of things. So some of it is pricing. So you have to consider, like, our entrance fees may be a little bit higher, but your state will receive 90% refund. Theirs may be a little bit lower, but you receive nothing back. It has been our practice since 1994, the belief that estate preservation was important to people, and so we plan that way, and that's the benefit of being a successful organization that has cash and that has been full for 29 years now.
Okay, great. They have long-term care insurance and they may keep it after moving into a CCRC. What is the median length of time spent in skilled nursing care by residents at RiverWoods?
More than 3 years. I don't know that off the top of my head, but it's a great question, and that's something, Teresa, I can find out, because I'm sure our healthcare and quality people know that, but more than 3 years.
Great. Okay. Justine, this is for you. Regarding reaching the end of your funds through no fault of your own, could you elaborate on the through no fault of your own, how that's typically defined?
Yeah, I mean, generally gifting it away, right? So if you come in with, you have a certain asset level and the investment markets go down, and that changes your ability to not outlive your assets, that's no fault of your own. But if you fill out your CDP and you say you have X dollars and then you give it all to your kids, that would be the other.
Okay. Justine, this one's for you as well. You made the comment, why are the other options less good than Riverwoods? Could you elaborate?
Well, it's just a little joke I say with our friends. I think all of the CCRCs in New Hampshire and in Massachusetts are quite strong, and they're all our friends. But of course, I think they're just a little bit less good than us. And I think my reason for that is what we talk about in terms of being willing to make hard decisions and being okay with looking to the future. So out of all of the organizations in our region, we're the only one who grew during the financial crisis. Another organization opened right before the pandemic and didn't do so well. So I like to think that we have the right combination of, we're not risk lovers, but we're also not risk averse. And sometimes you are more risky staying put. You have to be able to make the hard decisions and take some risk because we operate in a very dynamic world, and we've, no time has that been more obvious than the last 3 years.
All right, and I know we're about 15 minutes past the hour, so how about we wrap it up with one more question? And what we'll do with the remaining questions is we do have all of your questions here, so each of the marketing counselors can reach out to you to answer the questions. But this last question, how do you manage your healthcare employees? Are they hired, trained directly by Riverwoods, or are they contracted from other healthcare providers?
So there are healthcare employees are our folks. We have healthcare leadership on site. We have in Exeter, because we have such a large healthcare team, we have a senior director of healthcare in addition to our directors of nursing. And then we also have a chief clinical and quality officer who provides all kinds of oversight training on what is an incredibly regulated industry. We do, however, use what we call agency nursing. So because our health centers are so small, our minimum staffing is generally our maximum staffing. So if you have an opening, you need to fill that shift. We do use agency nursing, and that's something that has been, Keith talked about that with the elephant slide, a drain for us and all providers around the country over the course of the last 3 years.
All right, I said we'd wrap it up. Let's do one more question for Keith. On your slide for Riverwoods Exeter, you said days cash on hand shows a healthy approximate 700 days. However, it appears to be a trend downward, with fiscal year 23 being the lowest on the graph. What is driving that change, and how can the trend be reversed if desirable?
Probably more of a Justine question, but what I think is there's been some stock market changes recently, but that was not necessarily for 2023. Some bond market decline as well, but also the denominator is probably going up. So even if cash stays the same, that ratio will actually decline.
Yeah. Yep. And the other thing is just a healthy investment within our RiverWoods Exeter community. So we're putting, $7 to $10 million a year within our Exeter community, and that was a major renovation in our Ridge campus in the last couple of years. So that's going to adjust by and large, but I'm chuckling a little bit because we're still like 2 times the industry average. So, you know, it might drop a little bit. You don't want it to be too high because that means you're just hoarding your cash and not investing. So that decline doesn't give me any concern.
Great. And Justine, I'll ask if you could just turn to the last slide. That is our next event. And that is, here it is. So our next online workshop is that gratitude is a powerful catalyst for happiness. So we would be very happy for you to participate in that. It is Thursday, November 14th from 1 to 2. To register, you can visit the riverwoodsgroup.org /events or use the QR code offered here. So we want to thank all of you for taking the time today, spending with us on this important topic. And Keith and Justine, thank you very much for this very informative discussion. And for all of the questions that were still remaining, each of your marketing counselors will reach out to you with answers to those questions. So thank you again for participating with us.
Yep.
Thanks,
Thank you.
everyone.
Okay.